Some of the jokes that are on the video? Do I have some good jokes? I should charge for the stand-up comedian stuff. All right. So today we're going to delve into Chapter 12, which is a fantastic chapter. Like I said, we're going to fast forward a couple because we're going to have entire classes on payroll and on taxes, which is what is in between where we were and where we're going. So you're going to have entire courses on that. And today we want to focus strictly on accruals, deferrals, and the worksheet. And we're going to do a little accounting trick today. I'm going to preface that with we are doing a trick today. And I'm going to teach you the trick. And there is a way that we can all sit here and learn how mathematically the trick works. And we will eventually figure out how that works. But I think it's better off, after having taught this class several times, that if you just take my advice and learn that it's a trick. We're going to do something a little kind of weird with some accounting, and it all works out in the end, but you have to have kind of faith to move all the way through the process in the worksheet, and then you'll see how it comes out. So when we get to the trick and I say, here's the trick, you're just going to want to memorize the 4 steps of the trick, okay? And that's the easiest way to do this. If you just think, oh yeah, this is what Mr. Greer said, I just have to remember to do. So I'm going to preface that right now because it's way easier when we get to that point. So let's talk about merchandise inventory. Revenue. Oh, and accrual basis. Let's just go ahead and start off with accrual basis. Can anybody tell me what the difference is between cash basis and accrual basis in accounting? It's not a sucker. No, please, it's a sucker. It's all right.
Accounts receivable?
Oh, you're on the right track, but does anybody know what the difference? What's cash basis accounting?
Well, cash, you have to report. Tax-wise, you have to report when you spend it or when you receive it.
Okay, and what's accrual base for?
You report it whenever.
When you're really close. Cash basis is all based on when you get the cash and when you spend the cash. Accrual basis is based on when you earn it or when you owe it. So we might go do a job for someone. Let's say we are a ditch digger and we go out and we dig a ditch and they are going to pay us in 10 days. Well, we earn the money when? When we dug the ditch, right? That was the day we earned it. But did we get the money that day? No, we didn't get the money for 10 days. But that's okay. That's cash based. If we wait till we get the money to write it down in our books, that's called cash basis. If we write down that we did the job and somebody owes us money the day we did it, that's accrual base.
Yeah, most the small businesses do cash.
Yeah, so a lot of small businesses do cash, but when you start moving into being more of a legitimate business, like I would say more of a real business, we all use accrual basis accounting. So accrual basis accounting is a little more complicated because you have to do accounts receivables and accounts payables and things like that, and you owe people money, they owe you money, but it's technically what we try to do as accountants. So revenue is recognized when the sale is completed or when the work is done. A sale is complete when the title of goods passes to the customer or when the service is provided. For sales on account, revenue is recognized when the sale occurs even though the cash is not collected immediately. And this is important. So even if we didn't get all the money for the job or for the sale, if we go into more furniture for less, don't even pay till 2017. Come get your furniture today. They're not waiting till 2017 to write down that they made the sale. They're going to write down that they did the sale the day that you bought it, and they're going to collect money over the course of the next couple of years. Expenses are also recognized when incurred or used, not necessarily when cash is paid. So when we use something or we go to purchase it, even if we don't pay right up front for it, we owe it. So we need to recognize the expense. Each expense is assigned to an accounting period. And we're going to get into, in the next accounting class, something called the matching principle. This becomes very important. Matching principle is when we match revenues and expenses to the same period in which they were used to be earned with. So we're going to talk about that later. But
Hi, Laura. Use the cash instead of the accrual.
Which would be simpler?
Yeah.
I think that a lot of times we start off using cash because we don't understand accounting. I think it's simpler to use accrual because it keeps track of everything better.
It is, you made the last sentence it made sense, but it's not simpler.
I think that once we understand accounting, accrual is simpler. I think if we don't understand accounting, cash is easier. So I think that once we add the knowledge of accounting into our lives, accrual becomes natural. But if we don't understand debits and credits and what the whole accounting equation is, then cash seems like the default because we don't know any better. So it's almost like cash is better by ignorance. And I don't mean that bad, we just don't have the information. As soon as we understand it, then we probably want to move to accrual because it keeps better track of what we're doing. And it gives us a better picture of our business. Yeah. But there's a lot of businesses that don't want to know about accounting. We've talked about that, small business people just don't want to look at numbers. They just want to do their jobs. They're hoping everything's working out. They think they're making money. And at the end of the year, they go give their money to their accountant. They're like, he just takes care of everything. He's amazing. They just abdicate that responsibility. But we as small business people and as business majors and healthcare administration people, we know that numbers never lie. So we need to understand what the numbers are telling us. So we're fans of accrual-based accounting because it shows us what do we really owe in the future. In fact, a lot of times we argue, well, not we, but there's a group that argues that what the government tells us is the national debt is a lie because they're talking about what's owed that they've borrowed, not what they actually owe in the future also. Because it's not 17 trillion that they owe in the future, it's like 60 trillion because of promises made to pay for things in the future. So the debt issue is a lot bigger than it is when we look at an accrual basis, but that's a whole other complicated issue. So sometimes we just don't want to recognize things. We need to get a blog. So.
Our opinion into that.
Yeah. Mm-hmm. Well, and so as I said, this is the next step here, matching revenues and expenses. We call this the matching principle. We'll learn about this, I think, in chapter 14 when we get to that. So we are moving on to our big, our big piece of knowledge. And this is probably the most complicated thing to learn in this chapter. So strap on your thinking helmets. So here we go. We're going to talk about merchandise inventory. Now, does anybody remember what is merchandise inventory? What is that account? We talked about it last week. I think we talked about it the week before that too. It's the account we use when we're selling products. So when we have to buy merchandise, we're going to buy things and we're going to store that inventory in merchandise inventory. That means stuff that we're getting ready to sell. Okay? So it's maintained in the general ledger. And we have this little inventory here. And for all purchases of merchandise that are debited to the purchase account, and all sales of merchandise are credited to the revenue. So we bring inventory in, and purchases are going to be a debit, sales are going to be a credit.
Are we getting that?
I will give you this slide deck. I'll try to do it at the break. Now, no entries are made directly into merchandise inventory account during the normal accounting period. We didn't touch merchandise inventory. We just touched inventory, purchases, and sales. So consequently, when the trial balance is prepared, at the end, merchandise inventory account still shows the beginning inventory amount. We never touched this one after we brought it in, so we still have the same amount here, and that's going to be wrong. So we're going to learn a little trick to correct this. And when we think about it, the entire time we're doing a purchase and then a sale, a purchase and a sale. We're getting all this stuff done, but we're not ever putting things back into inventory. And it's because it's one more additional step that we'd have to do, and it would kind of make the books a little bit harder to do. So based on account, and usually in inventory, we talked about this last time, and inventory is done on a physical account. Did we talk about that in this class? Sorry, I'm teaching 4 accounting classes right now, so all of a sudden I just started thinking, okay. So I was thinking, wait, maybe that was accounting 213. But typically what we do to get our inventory is either once a year or once a month. Has anybody ever been responsible for taking inventory at a job? Did you have to go around and, like in the military, go count stuff and you just got to make sure as many things that are on the books are sitting on the shelves? Is that what they call them, CMRs? Yeah. So the reason they're doing that is to see if what's actually in the accounting matches what is on the shelves. because for some reason, things have a way of getting up and walking out without ever being purchased, especially if you work at Foot Locker. So based on a count taken on December 31st of merchandise inventory for Whiteside Antiques, totaled $47,000. So they went around the warehouse, they counted everything up, and they came up with $47,000 worth of materials. Now, they need to adjust merchandise inventory to reflect the balance at the end of the year. Because at the beginning of the year, well, I don't know, let's see if they'll show us at the beginning of the years. This adjustment's made in two distinct steps. First, we're going to remove the beginning inventory. Sorry, each step needs two general ledger accounts. So we're going to take merchandise inventory and income summary. Now, income summary, have we talked about this yet? Income summary? It's my favorite little account. I call this a slush account. This is one of those things that's a tool, not like your ex-boyfriend. It's a tool. So it's a tool that we get to use once a month. We pull this thing out like a screwdriver. We're going to do something with it, and then when we're done, we'll just put it back away, and we don't have to think about it anymore. Okay, so income summary is just a little thing that we get to use in order to accomplish what we need to, and I call it a slush fund. Now, income summary does not have a normal debit or credit balance. It's a weird slush account. That's why I'm telling you this, okay? It's totally different than anything else. It doesn't have to have a normal debit, doesn't have to have a normal credit. It is a weird little tool. First step is to remove the beginning inventory. So yeah, here we go. So at the beginning of the year, they started with $52,000. I'm going to write it up here. They started with $52,000. They ended the year with $47,000. How do we get to that? And this is a debit account balance. I hate this pen. Almost made it. It's a debit account balance. This is a debit account balance. So naturally, if we want to take $52,000 debit down to $47,000 debit, how would we normally do this? We would put a credit in of how much? That would be $5,000. We'll put a $5,000 credit in there. But is that really what happened with our merchandise inventory? Did we get rid of $5,000? No, all year we've been buying and selling, buying and selling. There's tons of stuff that's been happening. So to put in a $5,000 credit, this is not an accurate representation of what happened. We can't do that. It doesn't make any sense. So we're going to do this little trick. And this trick is the little key to making everything flow properly. What we do is we're going to say, what's the adjustment? We have $52,000. So they do this little weird. I'm going to do this up on the board also here so that you can see more of like what we do on the actual worksheet, which is what we're going to end up doing with this. So I'm going to have a little account here, merchandise inventory with the debit balance of $52,000. And I'm going to have an income summary account down here. Now this is our trial balance. The next thing we're going to go into is our adjustments. So I'm writing over my $52,000. Do you guys remember the 10-column worksheet where we have trial balance adjustments, adjusted trial balance, income summary, balance sheet? Yeah, you did it in chapter 6. Miss Chow. Remember this? Hold on, let me just flip it open. I'll show you. If you guys can all flip to page, it's the clear plastic section. This little thing right here, we can see how we did each little group, and you can look at this as overlays. So this is the, I'm doing a shortened version of that right now. So this is our trial balance. If you just flip to the section, yeah, there you go, this thing. And then we're going to have an adjusted trial balance right here. I'm going to do debits, credits, debits, credits. Okay. So we're going to start off with a debit balance of $52,000. Now, we need to get rid of the $52,000 because it's not the right number. Are we okay with that? What's our number supposed to be, Domingo?
5,000. We got
47. We're supposed to have 47, but we just need to completely get rid of 52. So if I want to get rid of something in accounting that's a debit, what do I have to do to it? How do I get rid of a debit?
You have to document it.
I have to do a credit. Thank you, Lisa. Okay, a credit. I have to do a credit for that amount. So I'm going to take this and I'm going to hop over and I'm going to give myself just automatically a $52,000 credit. Zero now. I have zero. I'm not even going to go forward on the slide. We're going to talk. This is the trick. So we're going to take this. We're going to wipe it out.
This is on your trial balance.
This is on your worksheet. Yeah, so trial balance adjustments, adjusted trial balance. Yes, just like that thing that you're looking at on that page. Okay, so what is the amount we want to end up with as a debit or credit? Debit. So I'm just going to write in what I want at the end here, which is a balance of $47,000 as a debit, because that's the number that's supposed to come out. And I'm going to take, how do I get a debit? I have to adjust for it. So I'm going to hop this one back in here. So this is a little weird, okay? So I'm going to just, the golden arches, right? We're just going to take this one, we're going to flip it over, we're going to take this one that we want, we're going to put it in there. Now we can't do anything in accounting without a double what? Double entry. So where are we going to put the second half of these entries? We have this little tool slush fund right here. So as we put 52,000 over here, we have to have a double entry. So we're going to put 52,000 debit. When we put 47,000 as a debit, we have to have 47,000 as a credit. Done. That is our little gimmick. Okay, this is a little accounting trick that we're going to use, and we're not going to get rid of this right away. We're going to actually take both of these numbers and bring them into the adjusted trial balance, which is unheard of. Up to this point, we would never do that. Both of these numbers come across. But the key to this whole little accounting trick is we're going to take the number we have, put it in the credit. The number we want, put it into the debit. Do that little hop and then hop. And then we have to do the adjusting entries for them down here. Now we're going to do this on T accounts. Excuse me. We're going to do this on T accounts on the board, but this is what I want you to remember this as, right up here, because this is what we do in the homework, this is what we do in the tests. It's all going to be in this form. It's not going to be in T account form. Are there any questions? We'll do this a couple times, but I just want to know if, right off the bat, are there any issues right off the bat? All right, let's keep going with the explanation then. So we have our adjustments for beginning inventory. What we've done is our income summary got the 52,000. Here we did that. Our merchandise inventory got the 52,000 credit. We did that. Now the next step is to place the ending inventory, which is that 47,000. And we're going to do that 47,000 debit, which is going to come across as our ending, and $47,000 credit. So I like to look at those two little hops. That's my trick. Just remember those two jumps. Those two jumps will save you a lot of time, effort, and aggravation. They say, Mr. Greer, this is a really bad way to teach me, is just tell me to learn a trick. I want to understand it. I'm going to teach you how to understand it, but it comes when we solve the problem. So I'm just saying, if you'll remember this trick, it will all make sense in about an hour, what we're going to do with it, because it all washes out in our income statement. But right now, this is a good little slush of fund that lets us put it where we need it in order to make what happen that needs to happen. So let's compute adjustments for accrued and prepaid expenses. So we're moving away from this little income summary right now. Are we okay? Can we move past this one? We'll come back to it. This is going to be our friend. We're going to use a lot of this as we go. I just want you to get the concept down. So as we move forward from this, there are other things that we incur over the month that we are accruing in cost. Sometimes we prepay things. What's a prepaid expense? What's one of the most commonly prepaid expenses? Starts with an R, ends in an ent. Rent. Thank you, Markale. Okay. So rent, we always prepay for rent. We pay, and then at the end of the month, they want us to pay for the next month. They don't want to wait till the end of the month to get paid for the month before. We're always prepaying a rent, typically in a commercial setting. So we'll pay for something, and is it really an expense at that point? We didn't use it yet. It's not an expense. So it's a prepaid asset when we pay it originally. And at the end of the month, though, when we have used all that time up in the location, that is when it becomes an expense. Because now we've used it, now it becomes an expense, and we have to take it out of something. A prepaid expense is an asset. Excuse me, a prepaid expense is an asset because we've paid for it in advance. It's a prepaid asset. That's what we've done with it. It becomes like cash.
Is an increased asset or
At the beginning of the month, if we have a prepaid expense, it's an asset. It's like cash. It's like getting a gift card to Jamba Juice. We might have gone and spent $25 at Jamba Juice to get the gift card, but what do we get back? Did we get a juice? No, we got cash that we can only spend at Jamba Juice now. And so we can still go purchase something with that. And we didn't really spend it until we bought the Jamba Juice, but it's only spendable in one place. I would argue that's a lot like what rent is. We're going to prepay for 1 month of rent, and we could do that. Now we could go, sorry, my allergies are going crazy today. We could go expense every day of rent, but that would get really monotonous. So we'd be going in and doing these entries. So what we do is we wait till the end of the month, and when we're doing these adjustments, we're going to go in and we're going to adjust for these prepaid expenses. Then we have losses. So under accrual accounting, the expense for uncollectible accounts is recorded in the same period as the related sale. This means that when we make a sale, we have to guesstimate, and we have different ways of doing that, how much of it is not going to be collectible. This goes back to the matching principle. One was the revenue earned and expensed. And as we move forward in this one, the expense is estimated because the actual amount of uncollectible accounts isn't known until later. So if we sell something to someone on account or on credit and they're not going to pay, what are the odds they aren't going to pay? But how do we know if they're not going to pay ahead of time? If you knew someone was not going to pay you, would you sell them the product?
no?
Heck no. Okay, that's right. We're not going to do it. So we're hoping that everybody's going to pay us. We don't know if they're all going to pay us. That's why we have credit scores. If you have a good credit score, who's going to sell you something? Anybody. If you have crappy credit scores, you're going to go to Joe's Car Shack in the, outside of town. They're going to sell you a 92 Plymouth Duster at 29% interest, and you're going to be thrilled to drive it away because they issued you credit to purchase the car. Okay? That's because they're willing to take a risk on you because they're charging you so much freaking money. Okay? And the car's not worth anything. So that's what we're willing to do. So what we have to do, though, is we have to realize that not everybody's going to pay. We have to be real. In accounting, we have to recognize that not everybody's going to pay us. So we have to estimate that at some point, how many people do we have? 2, 4, 6, 8, 9. The 10 people in this room, if we were all to go purchase something on credit, 2 of us aren't going to pay on time. Let's just take a number. We don't know what the number is until we get into our industry and we figure these things out. Maybe we have a much better paid demographic. Maybe we have a worse one. We just find these things out as we go along. So this estimated expense is debited to an account called uncollectible accounts expense. We're not going to be able to get this. So there are several different methods for figuring out how much people aren't going to pay us. If it was just we could be clairvoyant, that would be awesome, but we can't. So Whiteside, they use the percentage of net credit sales method. What is the percentage of net credit sales method? Let's put it together, make a formula out of the name, percentage of net credit sales. What would we do? We would take a percentage of what? Of net credit sales. Brilliant, Noel. Exactly. That's what we're going to do. So how do we know which percentage we're going to do? Well, it's based on the company's past experience. It's what we are used to with our customers, and you will get used to something. In fact, one of the beauties is numbers never lie. So if we start tracking this, it might not be perfect right off the bat. We might not know. Let's just say we're going to say 20% of the people aren't going to pay. And then when we start tracking it, and after a year we realize, it's not 20%, it's 2%. We'll just adjust our percentage down and say, okay, now our target is to hit 2% of everybody that walks in the door. 2% of those people are not going to pay us. And so we need to just understand that.
Isn't that called a statistic?
Is that what?
Isn't that called a statistic?
Call a stylistic?
A statistic, like
I think it's called STAS.
Elastic?
a statistic.
Oh, a statistic. Yes. Okay, good. Yeah, I was like, say it in German. No, I'm just kidding. So, it's like, pick a different language because I can't get at what you're doing. No. Yes, it is a statistic, and only on statistic. Yeah. So, I don't know. All right. Yeah, it is a statistic, and these are statistics, and you know what? We start getting into something in later accounting classes called ratios, and I don't want to pop our noggins right now, but ratios are what make the world go round in accounting, because we can look at things, numbers never lie, and if we analyze certain numbers in a business and we measure those same numbers against the same number as it was calculated with different companies in the industry, we can see if we're doing things right or wrong, or if we're close, if we're not close. We can start finding out similarities, and we can compare Coca-Cola to IBM using ratios, saying how much money do they make on a percentage of net credit sales? What is their uncollectible accounts on percentage of net credit sales? And is IBM higher than Coca-Cola? Does Coca-Cola even issue credit? We can go back and see all these things, and that's what allows us as investors to make choices on companies on which ones to invest in and not to.
Does this come in a special form, or do we have a special name for this?
Yeah, it's called percentage of net credit sales. No, just
Because I know for a fact that in restaurants they have to have like a percentage of you give them a format, I guess, or a form that's saying in 5 years your restaurant's going to make this much money.
Mm-hmm.
And there's a special name for it, correct?
You mean in a franchise? Is that what you're talking about? Well, there are lots of different names for different percentages, and return on investment is probably the one you're thinking of. ROI, is that what it is? Yeah, return on investment. So you put so much money in, you're going to make so much money back after a certain amount of time. That is definitely a ratio, and it's a thing that we measure on. This one, though, is based on how much money we're issuing out in credit and what we're not going to collect. So we want to measure. Now, why would it be useful to know if it's 2% or 25%?
So you know how much you make?
Yeah, because you're not making any of that money. If you're essentially giving away 2%, or you're giving away 25% of your sales, because you're not ever going to collect it. So it's important to know what that percentage is, right, Laura? Okay, just want to make sure. Did you have a fun weekend? Good, I did too. All right, so White-Styled Antiques estimates that 0.8%, so that's less than 1%. That's not 80%, okay? So 0.8% of net credit sales will be uncollectible. Did you guys see the Lego movie? No? No? Oh, sorry, I have kids. So we were watching the Lego movie this weekend, and Will Ferrell's in there. You know how he always does words differently? Like he would say uncollectible or something like that. That's what he was. Anyway, it just hit me. Net credit sales for the year were $100,000. So what is how much money are they expecting not to collect of that $100,000? Somebody do that on the calculator real quick. Laura's like, I'm going to let somebody else handle this one. I'm not going to whip out my iPhone. That's exactly what Laura was thinking. Yeah, I got $800. How did you do that? You times it by? Yep, that's it. Because we know we'd move that 2 decimal places. So that would be 0.008. That's what we would have done that by. Or if you have a percentage key, you could do it 100,000 times 0.8 percentage key, and it would come out with the same number. That's what Domingo did up front here. Okay, so the estimated expense for the uncollectible accounts is $800, done by this little math equation that we just did. Perfect. So we can figure out that after we sold $100,000, we're not going to collect $800 of it. Is that acceptable?
I would say it is acceptable,
It's acceptable?
depending upon, yeah. I mean,
So Domingo would have this business. I'd still be mad about the $800 though.
well, yeah,
But we have to understand that there's going to be a certain amount, if we're issuing credit, there's going to be a certain amount that doesn't come in. So the entry to record the expense, because this is what this is, an expense, includes a credit to a Contra Asset account called allowance for doubtful accounts. The allowance for doubtful accounts. We're going to need to remember that one. The allowance for doubtful accounts. And it appears on the balance sheet like this. We have our accounts receivable section. Then we have our Contra Asset, which is allowance for doubtful accounts, which shows as a negative, which then comes out to our net accounts receivables of the amount of the first accounts receivables minus our doubtful accounts, coming out with what our net is. Now they did theirs on a percentage of net credit sales, but there's some other methods to do. Oh, let's go through this really quick. So we have our uncollectible accounts expense. Then we're going to debit. We're going to credit our allowance for doubtful accounts. And we're not going to go into all the other methods. I thought we were going to hit the other methods. That's right. We'll jump to property, plant, and equipment. So what are these property, plant, and equipment? What is that? What kind of thing is that in accounting? Starts with an A.
Assets?
There you go. What kind of an asset? It's a really long-term asset, right? These are things that we buy, we hold on to for a long time. So a short-term or a liquid asset, current assets like cash. But a building, a plant, or some property, these are things that we're going to hold on to for a long time. We call these long-term assets. And they're used in the operation of a business and they're subject to depreciation. Now, depreciation is just a way that we slowly but surely expense off long-term assets. So we buy something, and over the course of 30 years, maybe, we use it, and it slowly goes away into nothing. And we make adjustments for 3 types of accrued expenses. So at the end of the month, when we're doing adjustments, we make 3 different types of adjustments. First is accrued salaries, money that's been earned during the month. Accrued payroll taxes. Accrued interest on notes payable. So because all these accrued interests or expenses involve amounts that must be paid in the future, the adjustment for each item is a debit to the expense account and a credit to the liability account. Now this is an important accounting concept. Once we expense it, even if it's before we've paid it, because we come to the end of the month. Let's say you're not going to pay your paychecks until the 10th of the month, but they earned for 10 days before the end of the month. You owe them that money in that month, and we need to expense that money in the month that it was earned. So like, for instance, here, they have us, we get paid on the 5th and the 20th because the end of the pay period is the end of the month. They do that for this. They don't have to do any accrued expenses. They can just expense everything out in the month that they're in. Even though they're not paying us for 5 more days because they're getting all the payroll done, that's fine. They go through, they write the checks, they get everything done, and boom, it comes out in 5 days. So they don't have to worry about all this accrued stuff. It's a smart way to handle it. But as soon as we put something down as an expense, it's done, okay? We might still owe the money, but we've expensed it for the one time that we're going to be able to expense it. We don't get to multiply, expense things multiple times. We only do it once. So if we debit our salaries expense, because an expense is always a debit, thank you, then we're going to owe, because we didn't actually pay those, so we're going to have a salaries payable liability that has a credit balance of $1,200. So we'll just use this same amount. Accrued payroll taxes, because we're going to owe the payroll taxes. And when you get into payroll tax, we're going to go through we're going to memorize all these things as accounting people. we would go through and you can look them up in the book though. This .062 and the .0145 is a standard number. We're just going to add those two up and we're going to owe payroll taxes of $91.80. So we're going to debit the payroll tax expense. We're going to credit Social Security tax payable and credit Medicare tax payable, the $17.40.
Now, why do we do Social Security on credit?
Because it's payable. So we're going to throw all of our taxes into one payroll tax expense, but because we haven't actually written the check yet, we owe it. So this becomes a liability. So this is Social Security tax that we owe, which is payable, so it's going to be a credit on that side of the equation, and Medicare tax payable, which is also a credit. Good question though. So we are expensing it out, but because we haven't written the check, we still have to put down that we owe it. Unemployment tax. So we have to do state and federal unemployment tax, come up with these two things. Same thing will happen. We're going to throw this back into payroll taxes expense because we are now expensing it off for the month, but we haven't paid it. So we're going to do a federal unemployment tax payable and a state unemployment tax payable. Any kind of accrued interest on a notes payable. A notes payable is money that we owe to someone. All right, so that's money that we owe. We are going to go ahead and issue a 2-month note for $2,000 at the annual interest rate of 12%. White-sided Antiques will pay interest when the note matures on February 1st, so we have 2 months of interest. But on December 31st, see here, the interest is accrued day by day and should be allocated to each fiscal period. So we want to make sure at the end of the month of December, we give the year 2013 the amount of interest that it had expensed up, that it had accrued, and we also give December that amount so we can see how much was issued there. So we have a good interest formula, and this is one of those formulas you should always just have memorized. To figure out interest, it's principal times rate times time. Principal times rate times time. So we can take 2,000 times 0.2, or 1.2, excuse me, by 0.12. Multiply that by 1 divided by 12, which is 1 month out of 12. So 12%, 1 month out of the 12 months, that would give us $20. So our interest for December is $20. So our expense for 2013 at the end of December would be 20 bucks. And we would do this on interest expense, and because we haven't paid it yet, it's going to be a credit to interest payable because we owe it, but we haven't paid it. All right, let's pause right there, and we're going to come back and we're going to do prepaid expenses. But it's time for Zoom. Click.
Is you gonna have the same book but different edition, or?
It's going to be a QuickBooks book. We're going to be doing QuickBooks next mod. There's 25 people, so you're going to want to get here early and get a seat because it's going to be completely filled in here. Standing room only. We're going to be in the same room, and so 5 people won't have plugs in the back. So you'll want to be in one of the 20 because we're on the computer the whole time. Yeah, that's how I motivate people to get here on time. All right, so let's keep going. Now we've got adjustments for the 3 types of prepaid expenses. First we have prepaid supplies. Then we have prepaid insurance. And finally we have prepaid interest on notes payable. So those are going to be the 3 different things that we're going to deal with in this, this chapter. Our homework is going to reflect that. Then let's compute some adjustments for accrued and deferred income items. I'm going to totally sneeze really fast and then go, here it goes. Whew. I have something really fun to talk about. It's really hard for me to incorporate my favorite company, Apple, into accounting. But this is the chapter I get to. Because a couple years back, Peter Oppenheimer, the stud machine CFO at Apple, started doing this thing called deferred income. And everybody was like, what the heck? They're using this thing called subscription-based income. And they're like, why would Apple be putting subscription deferred-based income on iPads and iPods and MacBooks and all this kind of stuff? And they couldn't figure out why. And that same year they started to, they dropped the price of their operating system. So like if you want to go buy Windows 8, how much does Windows 8 cost? $120. That's probably the cheap version, right? So Apple, though, about 4 years ago, dropped their operating system price down to $29. So when they came out with their new version of their OS, it was $29. And then the year after, it came out as $19.99. And the year after that, this last year, they gave it away for free. And everyone's like, wait, how are they able to do that? Can they actually give away their products for free? And then not only did they give away that product, they gave away their version of Word, which is called Pages, their version of Excel, which is Numbers, their version of PowerPoint, which is Keynote, their version of this movie thing and a photo thing. They're giving away all this software for free. And some investors were like, well, how can you do that? And it was because Oppenheimer had switched them to subscription-based. And so what they do is when they sell a product now, they don't collect all the money for the product for 2 years. And they consider like 20% of the purchase to be a subscription for software in the future. And so as they slowly go over the course of the next 2 years, they're collecting some deferred income of every purchase. So it's a pretty cool little thing that's happened in the real world that nobody had thought of, because normally subscription-based accounting is for things like a magazine. Yeah, that's the easy one. But they're actually applying that to computers so they can give away software in the future and make it legal and have accounting work properly, because they have people working on the software all the time. So they have to expense money for the software production in the same period that it was earned. So they do that by earning the money all the way through the next 2 years. It's pretty cool. So it's a complicated accounting thing, but it's kind of fun. Accrued income is income that has been earned but not yet received and recorded. Excuse me, just blew out you. Has been earned but not yet received and recorded.
I thought it was recorded.
Well, we're going to talk about it. So accrued interest is on the notes receivable. So on November 1st, 2013, Whiteside Antiques accepted from a customer a 4-month, 15% note for $1,200. The interest is recorded when it's received, which is normally when the note matures. However, interest is earned every day, Laura. It's important, it's not boring. At the end of the period, an adjustment is made to recognize interest income earned but not yet received or recorded. So the amount of interest earned is determined by using the interest formula, which is what? What's the interest formula? Look at that, Levon. Bam. Memorizing a formula. Oh, Elizabeth told you the formula. Okay. That's why it's important to remember this one, because it always comes up. So we'll do $1,200 times times 15% for 2 out of the 12 months is $30. So the fraction 1/12 represents 1 month, which is 1/12 of the year. So we had 2 months, which is 2/12. So if the note was for November 1st, we would have all the money due on December 31st. So there it is. So which account is debited and which account is credited? Whenever we're doing an adjustment for accrued interest on notes receivables, we're going to bring in interest receivable because this is interest that's going to be coming in. It's due to us, not that we've collected yet. And we're going to do interest income because we've earned the money, we just haven't gotten it yet after the 2 months. So unearned or deferred income exists when cash is received before income is earned and would include such items as subscription income, like magazines or Apple computers, management fees for property management, rental income, because we've earned it but we haven't gotten it sometimes, legal fees, whenever you have to get a lawyer, hopefully nobody has to. When we get a lawyer, what do you write them first? Big old fat check for what? Starts with an R, ends in a retainer, a retainer. You write them a retainer. So they get all this money ahead of time. They don't earn it until they bill hours. And as they bill hours, they write against that retainer. See, attorneys are smart. They get all their money up front. And they're like, we'll just refund you anything we don't use. Somehow they all use it. Yeah. And then architectural fees. A lot of times you pay for an architect up front, a certain amount. And then as they go, you keep making payments. because a lot of architects don't want to wait till the end and not get paid. And construction fees. I remember we used to charge a flat upfront percentage of the job, and then we would bill at certain spots in the job. As we got to one spot, we would bill for the next part. And got one spot, we'd bill for the next part. And then advertising income. If you pay for a month, or excuse me, like a Yellow Pages ad, if you ever pay for like an Orange Book or a Yellow Pages ad, it's a 12-month thing. And so they bill you every month for that ad. They don't just charge you one big lump sum. That would be another prepaid or deferred income that happens. So let's talk about completing this worksheet. And I'm just going to preface this with, this gets really hairy and looks horribly ugly up here on the PowerPoint. But when we get into the actual work, which we'll do for the homework, it'll make a lot more sense. So I want to try and dive into that a little bit today if we can. We're going to complete a 10-column worksheet. So the adjusted trial balance is the section of the worksheet that is completed as follows. First, we want to combine all the amounts of the trial balance with all the amounts of the adjustments, and we want to enter that into the trial balance, or the adjusted trial balance, excuse me. So we take trial balance, adjustments, and make the adjusted trial balance. It's like the perfect love child of these two. And then the accounts that do not have adjustments are simply taken from here and brought over to here. So if there's no adjustment that's happened, we just transfer it to the correct one. The most common mistake I see as an accounting instructor is people that transpose or take their numbers from one thing to the other one wrong. That's the most common thing I see on all these problems. So you want to make sure that everything you transfer is accurate. Because a lot of times you'll have everything right and you're like, it's not making any sense. And then I'll come over and I'll look at it. I'll be like, well, why is this one a debit here and you made it a credit when you transferred it? Oh, I'm an idiot. And then you change it, everything works. And you are an idiot. No. Because I just told you ahead of time. So the accounts that are affected by adjustments are recomputed, and we want to follow the rules to combine the amounts on the worksheet. So here, let's see if we can see this. This is a partial worksheet. And there's a lot going on here, and I can barely read it, and I'm really close to it. But I'm just going to tell you right now, these are all of our accounts. This is our trial balance. These are our adjustments, and this is our adjusted trial balance. So we're going to sit here, we're going to say 13,100 petty cash fund, or excuse me, cash fund, 13,136. There's no adjustments, so it's going to come over 13,136 debit. Same thing. Whereas we have something like our allowance for doubtful accounts is $250. We have a credit adjustment for $800. We're going to come across and it's going to be $1,050 over here. So it's adjusted properly. Sorry, I don't know why they couldn't make the slide perfect and have it fit right. We just slide across. Now in your test assessment thing that we have and the homework, the reason we use these letters, did you guys go over why the letters are so important? Because we haven't used one of these yet. Why are the letters important? Like this says C and O.
Because those are numbers that are
No, in our book, when we open it up, it tells us like letter A is going to be something. We want to put the letter next to it, and I'll show you on the homework sheet that we have how to do it. We want to put the letter next to it so if we have a problem, or if you're like, Mr. Greer, can you come help me? I'll come over there and I'll be able to look at it and I'll say, where's your two A's? And I can see the two A's. Or I can see the two B's. This helps us as we're getting used to doing this of keeping it all in order. So I would beg you, that's me begging you, make sure you don't skip and not do the letters. The letters are very important at this stage to keep track of what's going on in every problem. Now notice that the debit and credit amounts in the income summary do not combine. Going back to what we talked about at the beginning of this one. The numbers for income summary, which are right, I think it's see interest income. It's on the next page. Right here. Income summary. There's nothing to start an income summary because we get rid of it every month. We have two numbers. They're not combined, they just come both across. We're going to get rid of those when we get into the income statement. Okay? So we keep both of those numbers in our tool of an ex-boyfriend. Was that a question?
Just looking at her.
Sorry, I thought I saw a hand. And so we're going to come down here. This is our worksheet. We're going to go through and we're going to do our trial adjustments, adjust trial balance, income statement, and balance sheet. Once we finalize this whole thing out, these are going to be a little complicated down here. We will discuss these. I don't know if you remember that they don't balance. This doesn't balance and this doesn't balance, but together they should all balance out after we do the net income. This little piece down here. So for accounts that appear in the income statement, sales through interest expense, enter the amounts appropriate debit and credit column on the income statement section. We're going to go through how to do that. I think it's easier to do it than explain it. We want to identify the accounts that appear on the balance sheet. So the accounts that appear there are all of our assets, our liabilities, and our owner's capital and owner's withdrawal. Owner's withdrawal should be the last one that we see. Well, they don't have the bottom of it. Do they here? They're not giving us the whole thing. So we want to make sure that the owner's drawing account is the last thing, and then everything else goes on to the income statement. That's it. So why don't we jump into the homework? Good deal? Get a little jump start on it? Let me hit stop.